Alright guys, welcome back. So in today's lecture, we are going to talk about SMT. So what is SMT? SMT stands for Smart Money Tool. It's a tool used by ICT traders to assess the strength between correlated classes and pairs. It gives us confirmation of a stop run, and SMT should be used as confluence only. So relative strength analysis. Now we're going to look at first correlated pairs that are moving in the same direction. So we have pair 1 on the left hand side and pair 2 on the right hand side. As you can see, in pair 1 we made a lower low, and in pair 2 we made a lower low. We took out sell side liquidity in pair 1 and we took out sell side liquidity in pair 2. So these are both moving in tandem. There's no cracking correlation, and therefore there is no SMT present. So if we're looking at a correlated market, they should basically be making higher highs and higher lows in sync with each other. Now if we take pair 1 and pair 2, this time we see a lower low in pair 1 and a higher low in pair 2. We see sell side taken in pair 1, and we don't see sell side taken in pair 2. This is a crack in correlation, and there's a valid SMT divergence between pair 1 and pair 2. So what does this mean? So pair 2 is unwilling to go lower, whereas pair 1, we have taken the sell side liquidity. Pair 2 isn't willing to take that sell side liquidity. So pair 1 is going lower to make a run on stops, and pair 2 has the higher relative strength than pair 1 because it's failing to go lower. This is institutional accumulation. Now if we're looking again at relative strength analysis with inversely correlated pairs, so pairs that are moving in the opposite direction, we have pair 1, we're making a lower low. We have pair 2, which we've made a higher high. So we've taken sell side liquidity on pair 1, and we've taken buy side liquidity on pair 2. These markets are moving in tandem. They're inversely correlated, so as one is going lower and making continuous lower lows, the other pair is going higher and making continuous higher highs. So there is no cracking correlation, therefore there is no valid SMT here. However, if we take pair 1 and we're making lower lows, we should see the higher high in pair 2. The lower low is formed in pair 1, but a lower high is formed in pair 2. We've taken sell side liquidity on pair 1, so we therefore should have taken buy side liquidity, but we failed to do so. This is a cracking correlation, and therefore a valid SMT divergence between the two correlated classes. So what does this mean? So pair 1 has gone lower and taken out its sell side liquidity. If these markets were moving in tandem, we should expect pair 2's buy side liquidity to be taken. Because it hasn't, and we've made a lower high, this is a sign of institutional distribution, and therefore pair 2 has a lower relative strength than pair 1. Pair 1 is going down to make a run on stops, and pair 2 hasn't got the strength or the willingness to go any higher. This is the weaker pair out of the two of them. So how do we use SMT? So if we are in a bullish market profile and we see pair 1 making these lower lows, right, we're looking for, as always, price to come into a PD array. Now you should know these PD arrays by now, but we're looking for an old high, order block, fair value gap breaker, or a mitigation block to the left hand side of where price currently is. When price comes to this level, we then assess our second pair. As we can see, our pair 1 makes this lower low, takes out sell side liquidity and into our discount array that we're looking for, and pair 2 fails to take out its sell side liquidity. There's a cracking correlation between pair 1 and pair 2. Now this is when SMT is valid. We don't class SMT as valid unless we are expecting, number one, higher prices because we're in a bullish market profile, and this is what we're looking for. We're looking for a cracking correlation between the lows, and we're also looking for price to come into a level which we expect to hold as support. So there's a cracking correlation and a valid SMT divergence between pair 1 and pair 2. SMT is used as a confirmation tool. I had to put this separately because over the years a number of questions I've got about SMT where people are willy-nilly going into the market, and every time they see a cracking correlation between a high or a low, they think that that is a valid SMT and then are surprised when price does the opposite thing to what they expect. The reason for this is because we have to already anticipate SMT. So we're already looking at price to come to either a premium or a discount level. So we're already expecting price to bounce from this area. Never trade based on just SMT alone. You'll get your fingers burnt on this one. So my favorite correlated pairs that I look at, which I personally trade, is for Forex, the dollar index versus euro and the pound. The index market, S&P 500 versus NAS 100 versus the Dow, and crypto, BTC versus ETH. Now I'll go into a little bit of detail with some of these. So dollar index versus euro versus the pound. Now dollar index is inversely correlated to euro and the pound. So when we are seeing higher prices in the dollar index, we're looking for lower prices in euro and the pound. Now, how can we use SMT to filter where the best trade is going to be between euro and the pound? Well, if we're making steady higher highs in the dollar index and we're taking out buy side liquidity, we expect euro to make lower lows and take out its sell side liquidity. We should also expect pound to make a lower low and take out its sell side liquidity. When it doesn't, and we see pound fail to make that lower low and fail to take out its sell side liquidity, whereas euro did, number one, we can see the cracking correlation between dollar index and the pound. So this suggests that if we're in an underlyingly bullish market and we see the euro or the pound coming into a discount level which we expect price to bounce from, and we see this, we now can say that, right, it is expected that the dollar index has come to its premium level, is looking to go lower, pound is looking to go higher, but which is the stronger one out of the pound and the euro, and where's the best trade going to form? Because the pound is under institutional accumulation and it's failing to go lower, so there's an unwillingness for it to take out its sell side liquidity, there is relative strength in the pound versus the dollar. So we have our cracking correlation, and the pound is stronger than euro. Therefore, euro USD in this case is a buy, but pound dollar is going to be the stronger buy. So the S&P, NAS, and the Dow. So these three averages move in tandem with each other. So if we're expecting lower lows, we should see lower lows across all three classes. Now, if we see one fail to make that lower low and fail to take out its sell side liquidity, whereas the other two have done, and of course we've come into a discount level and are expecting higher prices anyway, this gives the confirmation that the index futures want to go higher. We only need to see a cracking correlation between one of the three to give us confirmation that SMT is valid and the market is likely to move higher. So the Dow, in this case, because it's under professional accumulation, is a stronger out of the three sisters. S&P is a buy, NAS is a buy, and Dow Jones is a strong buy. The S&P and NAS will move in sympathy to the Dow, since the Dow is under accumulation and is poised to go higher. Bitcoin versus Ethereum. If we see a lower low in Ethereum, again these are correlated classes, we should see a lower low in Bitcoin. If we fail to see that lower low in Bitcoin, and we're at a discount level for support and we expect higher prices, we should see the sell side liquidity taken for ETH and the sell side liquidity taken for Bitcoin. If we fail to see this, then Bitcoin is under institutional accumulation, and we should see Bitcoin run higher. Ethereum will therefore move higher in sympathy to Bitcoin. So I hope you guys found this one insightful. There is a lot of information, and you have to really go back and back test this one. I'm going to do another video on real life examples and chart examples to make things a little bit more clear for you. But in the meantime, I would suggest to go through your own charts, journal and annotate the charts as best as you can. I'll see you guys again in the next video, and thank you for watching.